stop. Before you scroll past this, I need 60 seconds of your attention. Because what is quietly happening in the silver market right now is something most people will only understand after it is too late. My name is Zara, and I want to start with a mistake I once made. Years ago, I watched an asset build slowly for months. I understood why it was moving. I had done the research, but I kept waiting for more certainty, more confirmation, the perfect moment. And then the move happened without me. Fast, dramatic, exactly as the fundamentals suggested it would. I was right about everything except my own behavior. That lesson never left me. Today, when I look at silver, I feel that same quiet build beginning again. So let me take you back to 1980. The 1970s were a decade of financial chaos. Governments were spending beyond their means. The United States had abandoned the gold standard in 1971, meaning the world's most powerful currency was now backed by nothing except trust. Inflation was rising. Savings were losing real value silently year after year, and ordinary people had no idea what was coming. In that environment, silver began building. Slowly, quietly, ignored by the mainstream. And then, between 1979 and early 1980, it exploded. From around $6 per ounce to nearly $50 in months. One of the most dramatic commodity moves in modern history. Then it crashed just as fast. Investors who arrived early, driven by understanding, changed their financial lives. Investors who arrived late, driven by excitement, lost fortunes. That contrast between those two groups is the entire lesson of 1980. 3 things I want you to carry through this whole series. First, fundamental forces build slowly but release fast. Most people miss the build and only catch the explosion. By then, positioning intelligently is nearly impossible. Second, understanding why something moves is worth far more than simply knowing that it is moving. Analysis produces calm decisions. Excitement produces emotional ones. Third, every asset has a story. If you understand that story deeply enough, you can hold through volatility without losing your nerve or your money. Today, those same forces are building again around silver. Not identically, but closely enough that every serious investor needs to pay attention right now. Over the next 4 parts, we will cover why today mirrors the 1970s, what makes silver uniquely powerful right now, the mistakes that destroy good ideas, and a real, practical strategy for long-term positioning. And in Part 5, a warning that matters more than any price prediction you will ever hear. But first, let me be clear. This is not financial advice. Investing carries real risk. My job is to give you the knowledge to make your own intelligent decisions, nothing more. The story is beginning, and the investors who understand it before the crowd will be the ones who look back years from now and know they paid attention at the right time. The greatest financial mistakes in history were not made by unintelligent people. They were made by people who assumed that because things had been stable for a long time, they would stay stable forever. They forgot that underneath every period of apparent calm, forces are always quietly building, and eventually, those forces always surface. Today, I want to hold up a mirror. I want to place the economic picture of the 1970s beside the picture of today, and I want you to see what that comparison honestly reveals. The first similarity is inflation. In the early 1970s, after years of government overspending and monetary expansion, inflation broke out in ways that caught most people completely off guard. Policymakers insisted it was temporary. They were wrong. It touched food prices, energy prices, housing costs, and the daily lives of ordinary families in ways that genuinely changed how an entire generation thought about money and savings. Now look at the last several years. Governments around the world engaged in levels of spending that have almost no peacetime historical comparison. Trillions were created. Debt reached heights that would have seemed impossible 2 decades ago. Deflationary forces from technology and globalization suppressed inflation for a time. People began believing the old rules no longer applied. They were wrong. When inflation arrived, it arrived with real force. People felt it personally and immediately. And the underlying monetary conditions that created it have not been genuinely resolved. That is the first mirror. Inflationary pressure is back in its essential form. The second similarity is weakening trust in paper currency. When the gold standard ended in 1971, a quiet unease began among certain economists and governments. A currency backed only by confidence is permanently vulnerable to losing that confidence. For decades, this concern stayed in the background. Today, it is front and center. Major economies are actively reducing dependence on the dollar for trade and reserves. That conversation is no longer fringe. It is happening at the highest levels of global finance. And when institutional trust in paper currency weakens, history tells us clearly where serious money flows: into hard assets, into gold, and into silver. The third mirror is the most powerful and the most unique to today: industrial demand. In 1980, silver was primarily a monetary metal. Its industrial use was modest. Today, silver is a critical material of the modern economy. Solar panels, electric vehicles, advanced electronics, medical devices. Silver is consumed in manufacturing processes and does not easily return to the market. Unlike gold, which moves between vaults, silver gets used up. This means silver today is being pulled by two forces simultaneously: the monetary force that pushes silver higher when paper currency weakens, and the industrial force that pushes silver higher as technology demands more of it. In 1980, only one of those forces was active. Today, both are building together. That combination has no precise historical parallel. The conditions are real. The mirror is clear. And in the next part, we talk about why most people, even with all of this understanding, still manage to lose money on the right idea. Here is one of the most painful truths in investing. Being right about an asset is only half the battle. The other half is behaving correctly while you are right. And that second half is where most people fail completely. Most investors who correctly identify silver as a long-term opportunity will still lose money on it. Not because their analysis was wrong, because their behavior was wrong. Let me show you exactly where those behavioral failures happen. The first mistake is the urgency trap. You discover silver's story, the fundamentals click. The parallels to 1980 feel real and compelling, and suddenly you feel you must act right now before the price moves. That urgency drives you to commit everything at once. This is dangerous. Because silver can stay flat or even fall for months before the thesis plays out, and if you committed everything driven by urgency, that waiting period becomes unbearable. Doubt accumulates. And right before the real move begins, you sell. You exit at a loss on an idea that was correct all along. The protection is simple. Build your position gradually. Divide your total intended allocation into equal portions and invest one portion at regular intervals over 12 to 18 months. This removes urgency and replaces it with a disciplined process you can actually sustain through the inevitable slow periods. The second mistake is confusing volatility with failure. Silver can fall 30 or 40% in a short period and still have a completely intact long-term story. But when investors see those red numbers, the emotional response overrides the rational one. They feel genuine discomfort, and they sell, locking in a permanent loss right before the recovery. Then they watch from the sidelines, feeling the worst kind of pain, the pain of having been right and still having lost. The only protection against this is conviction built on genuine understanding, not excitement, not hope. Real understanding of why silver holds long-term value. With that understanding, a temporary 30% drop looks like an opportunity. Without it, it looks like a verdict. The third mistake is position sizing driven by excitement. Silver's story is compelling, and compelling stories make us want to go all in. This is financially dangerous. Even correct investment ideas can take far longer to perform than expected. A portfolio overly concentrated in any single asset is a portfolio that cannot survive the worst-case version of that single idea. Size your silver position meaningfully, but rationally. Large enough to matter, small enough that your financial life stays completely stable if silver underperforms for several years. The fourth mistake is checking prices too often. Silver investors who monitor daily prices turn every small movement into an emotional event. This habit systematically destroys the long-term perspective that is the only perspective from which silver's genuine potential can be captured. If your thesis is 5 to 10 years, the price today versus tomorrow carries almost no useful information. Check the fundamentals quarterly, not the price daily. The fifth mistake is confirmation bias. Once invested, there is a powerful tendency to seek only information that validates your position and dismiss everything that challenges it. The investors who build real wealth hold their conviction firmly while remaining genuinely open to being wrong. They engage seriously with the strongest arguments against their thesis. They update when facts change. They are never so attached to being right that they cannot change their mind when reality demands it. Knowing these traps before you fall into them is the most valuable preparation you can do as a silver investor. This is where everything becomes practical. We understand the history, we understand the economic conditions, we understand the psychological traps. Now comes the question that actually matters for your financial life. How do you engage with silver intelligently, with real money, over real time, in a way you can genuinely sustain? Step 1 happens before you buy a single ounce. Build your financial foundation first. That means liquid savings covering 3 to 6 months of your actual living expenses, sitting in a stable, accessible account, completely separate from any investment. If that foundation does not exist, investing in silver is not a strategy. It is a gamble. Because the moment life creates an unexpected financial demand, you will be forced to sell at whatever price the market offers at that moment. And that moment may be exactly when prices are at their lowest. Foundation first, always, without exception. Once that foundation is solid, decide your allocation. For most thoughtful long-term investors, a silver position somewhere between 5 and 10% of total investable wealth is appropriate. Large enough to matter significantly if the thesis plays out, sized carefully enough that your financial life remains completely stable if silver takes longer than expected. Going beyond 10% requires a level of genuine expertise and honest risk capacity that most investors do not actually possess, even when they believe they do. Now let us talk about how you actually own silver. There are three main ways, and each carries different characteristics. Physical silver, actual coins or bars held securely, offers the most direct ownership. No counterparty, no financial institution between you and the metal. For investors drawn to silver as a store of value, independent of financial systems, physical silver carries a meaning no instrument can replicate. Plan for secure storage and factor in the wider buying and selling spread. It is best suited for patient long-term holding. Silver exchange-traded funds offer liquid, transparent, easily accessible price exposure through any standard brokerage account. For investors building positions gradually through regular purchases, a reputable silver ETF is practical and efficient. Understand that you own a financial claim, not the metal itself. For most investors, this distinction is manageable. Silver mining companies offer leveraged exposure. When silver rises, well-run miners tend to rise by more because revenue grows while costs stay relatively fixed. But leverage works both ways. Miners fall harder when silver falls. And they carry risks completely unrelated to silver's price, including management quality, operating costs, and geopolitical factors. Investing in miners requires deeper research than owning the metal directly. A balanced approach might combine all three: a core physical position for fundamental integrity, a silver ETF for liquidity and easy accumulation, and perhaps one carefully researched quality mining company for additional upside leverage. Build your position through structured accumulation. Determine your total intended silver allocation. Divide it into equal portions. Invest one portion at regular scheduled intervals, regardless of what the price is doing. This naturally lowers your average cost over time and, more importantly, removes the emotional weight of trying to time the perfect entry. You replace anxiety with process. Measure success honestly, not by comparing this month's price to last month's, but by asking over 5- and 10-year periods whether silver has preserved and grown real purchasing power, whether it has served its role as a counterbalance to paper currency-denominated assets, whether the fundamental thesis remains intact. Those are the right questions, and they can only be answered over time. Silver rewards the patient, the disciplined, the investors who own it for the right reasons, sized correctly, built gradually, and measured honestly over the long term. This is the final part, the most important one. Everything we have covered across these 4 parts, the history of 1980, the economic mirrors, the psychological traps, the practical strategy, it all comes down to this final conversation. Because the biggest failures I have witnessed in silver investing did not happen because people lacked knowledge. They happened because people ignored a set of quiet but critical warnings that nobody bothered to give them before they committed their money. Consider this your warning. The first warning is about narrative addiction. Silver carries one of the most compelling investment stories in all of finance: monetary history, industrial revolution demand, energy transition, dollar dynamics, supply constraints. Each element is genuinely interesting. Together, they form something almost irresistible. And that irresistibility is a danger. Because when a narrative becomes compelling enough, it stops being a tool for analysis and becomes a replacement for it. You stop questioning whether the story is still accurate. You start defending it emotionally. You stop being an investor and become a believer. Believers make the worst financial decisions because they cannot update when facts change. Every 6 months, revisit your silver thesis with genuinely fresh eyes. Read the strongest arguments against it. Ask honestly whether the fundamental conditions that made silver attractive still exist. If they do, hold with real confidence. If something has genuinely shifted, adjust without ego and without shame. The willingness to question your own conviction is not weakness. It is the most valuable quality a long-term investor can develop. The second warning is about how silver actually moves. Silver does not trend gently upward. It trades sideways for long, frustrating, seemingly endless periods. Then it moves suddenly, sharply, and faster than most investors can react to meaningfully. This pattern has repeated throughout silver's entire modern history. The investors who capture silver's major moves are almost exclusively the ones who were already positioned before those moves began. The ones who held through the boring periods without abandoning their position. By the time silver is making headlines, by the time it is being discussed excitedly by mainstream media, by the time it feels safe and obvious and broadly validated, the early investors have already been positioned for months or years. The most comfortable entry points carry the worst risk-reward. The best entry points are always deeply uncomfortable. Remember that, because the market will test your patience in exactly the moments when the opportunity is greatest. The third warning is about silver's behavior during financial market stress. When equity markets fall sharply and suddenly, silver often falls with them in the short term. Not because its fundamental value changed, but because in acute stress, investors sell liquid assets to raise cash quickly. Silver gets sold alongside everything else. In the very moments you might expect silver to protect you, it may temporarily decline alongside the assets you wanted protection from. Knowing this in advance allows you to hold through those moments clearly, rather than panic through them in confusion. Unexpected behavior in an asset you thought you understood is one of the most reliable triggers for the worst investment decisions. Understand silver's behavior fully before you experience it, not after. The fourth and final warning is the most personal one I will share in this entire series. The richer and more emotionally resonant a narrative is around an asset, the more likely investors are to let anxiety drive their allocation rather than strategy. Silver's story connects to real and legitimate concerns about inflation, about monetary stability, about the long-term value of paper currency. These concerns are valid, but when anxiety drives investment decisions, position sizes grow beyond what rational risk management supports. The investment becomes emotionally central to your sense of security, and what was supposed to provide financial peace of mind becomes instead a permanent source of financial stress. Silver belongs in your portfolio as a meaningful, appropriately sized, strategically positioned component of a diversified long-term approach. It does not belong as the foundation of your financial identity or the primary vehicle for managing your fears about the world. Keep it in its proper place and make every decision about it with strategy, not with emotion. Now let me bring everything together into the clearest possible final takeaway. Silver today is genuinely interesting for real and historically grounded reasons. The monetary conditions rhyme meaningfully with the 1970s. The industrial demand from solar, electric vehicles, and advanced technology creates fundamental support that did not exist in 1980. The supply picture is tightening. Mainstream awareness remains relatively low. These are real fundamentals that deserve serious attention. But silver rewards only the patient, only the disciplined, only the investors who build positions gradually, size them rationally, understand what they own deeply enough to hold through volatility, and measure success honestly over years rather than weeks. The investors who arrive with urgency, who over-concentrate because the story excites them, who react to daily price movements, who confuse narrative with analysis, will almost certainly be disappointed. Not because silver failed them, because they brought the wrong relationship to the asset. My final advice is simple and direct. Do your own research. Build conviction from genuine understanding, not from excitement or fear. Size your position with honest discipline. Build it gradually through a structured process. Hold it with patience, grounded in understanding rather than hope. Revisit your thesis regularly with truly fresh and honest eyes. And never invest money in silver or in anything else that you cannot comfortably leave untouched for 5 to 10 years. That is the standard. That is what long-term investing actually demands. Not brilliance, not perfect timing, patience, discipline, understanding, and the character to hold a correct position through every moment the market will use to try to shake you out of it. Silver's story is building, quietly, the way it always does before it moves. I am Zara. Thank you for being here through all 5 parts. Take this seriously, apply it carefully, and build your financial future with the clarity and discipline it genuinely deserves. Final conclusion, 2 to 3 minutes voiceover by Zara. So here we are, at the end of everything we have built together across these 5 parts. My name is Zara, and I want to leave you with the clearest and most honest summary I can give you. Silver today is interesting for real reasons, not because of hype, not because of excitement. Because the same fundamental forces that built slowly through the 1970s and released explosively in 1980 are quietly building again right now. Monetary pressure is real. Industrial demand is growing structurally. Supply is tightening. And mainstream awareness remains low enough that serious long-term investors still have time to position intelligently before the crowd arrives. But here is what I need you to remember above everything else. Silver will only reward the patient, the disciplined, the investors who build positions gradually, size them rationally, and hold them with conviction grounded in genuine understanding rather than hope or excitement. If you approach silver with urgency, if you over-concentrate because the story thrills you, if you check prices daily and react emotionally to every movement, you will be disappointed. Not because silver failed you, because you failed yourself. The 1980 story is not just about a price on a chart. It is about what happens when monetary reality that has been delayed for years finally forces itself into the open. We may be approaching another such moment. The signals are there for those willing to read them honestly and act on them patiently. Build your foundation first. Allocate wisely. Accumulate gradually. Hold with discipline. And measure success over years, not weeks. I am Zara. Take this knowledge seriously and build your financial future with the patience and clarity it truly deserves.